From the morning reading, financials, small caps lead Friday the 13th rally. The Qs move to a new all-time high. Breadth strengthened compared to the prior session as advancers led 1793 to 1198 on the New York Stock Exchange and led 1802 to 965 on the Nasdaq. On the S&P 500 snapshot, up 0.18% for the day, down 0.10% for the week. The S&P 500 rose at the open, hitting its 0.36% intraday high about 15 minutes into the session on strong bank earnings. The index then traded on a narrow range through the morning, dipped during the lunch hour, and then sold off to its 0.05% mid-afternoon low, and then recovered to a trimmed gain of 0.18%. In other news, smart money is selling while stocks stall. Over the past month, the S&P 500 is flat, but smart money confidence has declined nearly 20%. Usually the confidence only drops that much when the S&P has rallied by at least 3% over the past month. When we've seen situations like this, any further short-term gains were erased by a subsequent correction, except for 2013. Futures traders are afraid to start the day short. The S&P 500's futures haven't seen a gap down of more than 0.5% for more than 2 months. Its largest gap down has been a meager negative 0.38%, the second smallest of this bull market. When the futures go this long without even a modest gap down opening, there's been a sign of complacency and led to negative short-term returns. Small caps recover from Thursday's sell-off to keep sideways trading range intact. The Nasdaq rises to new records. An hourly look at the 4 sectors that showed improvements. Bond yields pull back to support and are still upward in an uptrend. Small caps survived the test of support. The stock market continues to trade sideways within the context of an overall uptrend. The fact that small caps stabilized at week's end is an encouraging sign because they often lead larger stocks. At one point Thursday morning, the Russell 2000 IWM traded briefly at its lowest level in a month as major stock averages weakened. An afternoon bounce, however, kept the IWM above the short-term support. Nasdaq shows new leadership. Another positive sign for the overall market is the new leadership from the technology-dominated Nasdaq market. The chart shows the Nasdaq Composite Index surging to record highs this past week every day except Thursday. The Nasdaq SPX ratio has turned up as well. The uptrend in the Nasdaq shows that the market's trend is still to the upside. Bond yields are still in an uptrend. While stocks have been stalled in the new year, we've seen a pullback in the 10-year Treasury yield. The fact that yields have dipped has boosted Treasury prices, which had become oversold. That may have also contributed to softness in stocks. Hello, this is Stephen Harris, the head trader for Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:12 a.m. Mountain Time, and I'm recording this in preparation for the market day of January the 17th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and jump into the morning report. Okay, at the time of this cut, the S&P futures were weak, down about almost 1/3%. Russell futures are down almost 2/3%. Nasdaq was down about 1/4%, as is the Dow. Crude oil is up about 1.5%. Euro is up about 1/3%, as is long bonds. And gold is up about 1.2%. One thing I noted was the volume. This is a very, very high overnight volume. So kind of keep an eye on things today. There's been a lot of activity in the overnight, and that could lead into the open today. China is up just about scratch. Hong Kong up about 0.5%. Japan down about 1.5%. Germany down about 0.25%. United Kingdom down about 0.2%. So, with the exception of Hong Kong being up about 0.5% and China just above scratch, everybody else was pretty weak in their various respective country index, including all four of our primary indexes. So kind of keep in mind on where this might be going today. It could be a little weaker than has been of typical lately. In terms of macroeconomic reports for today of note, in the United States, we have Empire State Manufacturing, FOMC member Dudley speaking, Treasury Secretary Liu speaking, FOMC member Brainard speaking. So a whole bunch of speaking. In terms of looking forward to tomorrow, this is kind of crunched. I had 2 big days here to get on here, but we have CPI, capacity utilization rate, industrial production, a housing market index, FOMC member Kashkari speaking, Fed Chair Yellen speaking. That looks to be about it. So there's an awful lot of people on slate to talk in front of audiences, yes, between them today and tomorrow. And any of that could kind of send a ripple through the market. So it makes for kind of its own kind of volatility. In terms of current volatility, we are relatively low. Short-term VIX, 8.99. Skew, it started to climb. It's up over 132 now, so that's the second level of caution threshold. IV percentiles continue to be exceptionally low, though, with the S&P at a 6, the Russell at 12, the NASDAQ at 5, and the Dow at an 8. No standard deviation size moves were put in on Friday's session on a close-to-close basis. Okay, let's go ahead and go to the charts. In our S&P chart, you see we'll continue this sideways consolidation action. We had the undercuts on Thursday, but then quickly back and rejected back into the range. So we continue to have day after day really with open and closes pretty much within a 1.5% range. Dow continues the same kind of pattern. Nothing really exciting to get into without really cutting very fine, subtle distinctions between those two. NASDAQ, of course, has been the most bullish and has been in contrast to the other Dow and S&P in the last week, in that it's continued to make a bullish move. And on the 13th, or Friday's session, did have a new all-time high and closed near the high, so quite bullish there. Giving back some of that so far today. And the Russell also continuing in this sideways continuation pattern. So really nothing happening on any of the U.S. indices in terms of chart action, just in a very tight, coiling kind of consolidation pattern. We take a look at gold. Now, gold has been on the move, and gold is as dominant as this downtrend was, where you really hardly even had a swing. It was just a straight move down. Ever since it broke that diagonal resistance, has been in a straight move up, and now is probing into the Ichimoku cloud. So very, very remarkable action there. And then bonds. Now this is interesting. Bonds, while it had also had a move on the chart much like gold, has in the last week gone sideways. It's up, fairly strong action today, but seems to be really struggling to be able to pierce the cloud and become, a bullish continuation pattern. And then let's take a look at crude oil. Crude oil also in a sideways correction after an undercut last week. So let's see where the dollar has been in all this. Oh, the dollar's very weak today and has bounced off of that former area of resistance, now turned support. We'll see if it starts to break down through that area. But this obviously is very much the reason for this action in the gold and bond and crude oil markets. Let's go ahead and take a look at volatility. Volatility's ticked up a little bit, but still, at a 12.51. Anything in 12 to 15 range we consider just normal bull market kind of noise. So we started out from such a low level that an uptick in volatility, seems like something, but really this is still very, very low volatility. There is not a lot of buying of puts. There's still an enormous amount of complacency in this market. Now, this uptick can always be the start of something, but until we see further building on this volatility and we start to see this range get up, the 15 and 15 plus, that's all we take of this. It's just a slight uptick across from a baseline of extremely low volatility. We don't get too excited about that. Okay, so the chart's frankly pretty boring this morning. Not a lot going on. Mostly stories of consolidation and sideways activity. Let's go ahead and bounce over to the daily report. Still market phase 3, bull flags and other bullish continuation patterns on our S&P index. And then as well, looking at the 3 market timing signals, all mechanical in nature. The first one coming to us from IBD, still in confirmed uptrend. GMI index, a 5 out of 6, buy signal in place since 11:10. That one's also bullish. And then stock charts decision point scoreboard, still with these mixed signals in the short term and in the long term. So leading us to believe that we'll have relatively subtle new highs, but also relatively subtle pullbacks and corrections. Much of this just kind of giving us a overall bias to the bull side, but not really strongly leading to anything on either side. In terms of position models, the portfolio investor position sizing models at 100%, as is the active trader model at 100%. Intermediate term market posture, exceptionally strong bulls on the first 3. The Russell is a first day strong bull signal, and do note this has been oscillating back and forth between strong bull and weak bear in recent price action. But overall, the consensus here is also for an exceptionally strong bull market, and that's also supported by an exceptionally strong bullish sentiment line. Strength of the trend is still very, very strong. Hedge warning status 0+, normal with some elevated conditions. Option income strategies, we've had this in the warning area in that the VIX was actually too low to be an acceptable range to initiate new positions. Now with the action this morning, we've actually moved back up into the window of above 12. And covered calls and put selling, no change from recent opinions here. Conditions are acceptable to initiate new positions for novice traders. Somewhat conservative still with the 1-to-1 ratio of out of the money and in the money strikes, also a 1-to-1 ratio of high beta and low beta positions. And that is a reflection of the fact that we've gone so far since the post-election rally that it makes it more difficult to continue to add a lot of positions on it here. Hopefully you were adding all along and gaining additional delta exposure. But if you hadn't, to be able to pile in at this point after making such a big move without something of a retracement, is a bit questionable. Look for opportunities in individual charts and stay relatively conservative unless you get a pullback, especially on put selling. If you get a pullback that becomes a buying opportunity within the context of what the other indicators are telling us. Okay, in terms of the specific areas of warning, most of this is in the volatility-based area and is related to low volatility and the expectation that that low volatility will expand. Distribution day count on NASDAQ still elevated at a 5, though just barely. If that drops to a 4, that would give us a below threshold status. Of course, the skew now up over 130 actually. It's about a 10% probability of a 2 standard deviation move in the next 30 days. Into the trend-based area, these are all fine. Intermarket risk aversion indicators, we still have the 1 risk on versus the 4 risk off, so those continue to be a source of some concern. Fear and greed index, very benign really, a 57, really in that almost neutral category. In fact, Thursday was at 55 and was considered neutral, so just a slight uptick on Friday's session. You see with the Friday session, we also had a fairly balanced day. Not anybody got too big or too little. Financials were the hero of the day. We're up about 0.67% with very good breadth. Almost all the financials were in good shape. Remember, the banks had some earnings reports with Friday's action, and that certainly was supportive of the financial sector. Industrials, consumer discretionary, all these other risk-on kind of categories also doing well. Mostly defensive, being down here at the bottom. Staples, telecom, utilities, real estates, all in the red for the day, and with the majority of their holdings and components in the negative side. Though, even the most negative was down only 0.25%. Really, Friday's action leading into the 3-day weekend was one of the typical early morning move and then kind of sideways into the close as everybody headed out the doors for the 3-day weekend. In terms of market postures, we continue to see weakness from consumer staples, energy, and retail is mostly of note. And percent changes, we continue to see this kind of the rally, which is contained in the 3-month data, but then the 1 month and lower has been generally sideways and not much been gained or lost by any of the sectors since that 1 month time frame. You see technology up almost 3% and energy down almost 3% as kind of the extremes for the 1 month time frame. Lots of chop here in the shorter time frames. In the relative rotation graph, we continue to see the regional banks just on fire. Transportation still strong, but tailing down a little bit from where it was. IYZ, telecom, building, also home construction improving. So kind of keep an eye on those sectors. I think that's probably enough for today. Let's go ahead and start wrapping this thing up. And I'm going to scroll through these slides. If you see something of interest, just hit the pause button, get your details, go to that hyperlink that's indicated, and get additional details. I will mention one thing about YouTube. We just went over some 20,000 views, and we're very appreciative of that. We're closing in on 300 regular subscribers, and you can certainly subscribe to the YouTube channel for free. It's just a matter of going to the button. Once you go to the channel page, hit the subscribe button, and that'll put you in, and maybe you can become our number 300th subscriber and help us go from 20,000 views to some 30 or 40 or 50,000 views in very quick order. So we're very appreciative, and frankly, while you're there, hit that like button. That gives us that pat on the back, because we are doing this for free and spending a fair amount of time each morning in our own preparation to share the findings that we have with you, and it's just it's nice to see those likes and so forth. It's nice to see those subscription numbers build, to kind of give me an indication that what I'm doing here and sharing with you here is helpful to your trading. So kind of a couple things to keep in mind there. A couple other things with the tools here. Make sure you're watching this in high def. If you're a subscriber, you'll get notice when content has been published. Give it just a moment to be available in high definition. Or the other alternative is to go ahead and start listening, because I almost always have some morning reading at the beginning, but make sure that you flip it up to high definition playback by the time I get into the charts. The other button there is the speed button, and you can change that playback speed to 1.5x and probably fully comprehend everything that I'm saying. But you can control that speed, speed it up or slow it down according to what you need in terms of comprehension. Also note the full screen button. So several little toggles there that allow you to control how that playback looks and sounds. Other opportunities here. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note at the bottom the full set of disclosures can be found at this hyperlink. We'll see you next back here tomorrow morning for the Falcon Global Market preview. In the meantime, manage that risk, stay consistent, and then, of course, seek to learn something about your trading craft each and every session. Good trading.